Welcome, everyone, to the 2022 halftime report. First, I want to say thank you for attending, and thank you for your business. We appreciate being able to serve you. 2020 and 2021 were two really good years in the market. And so if you take a look now, you say, oh boy, what are we doing? You got Russia, you got China, you got a south border, you got inflation, and everybody's scratching their heads going, so where are we going to go? And that's where we're going to bring up my partner and Chief Investment Officer, Caisse. He's going to cut through all the noise and give you the answers. So, Eric?
Good evening. All right. Great to see everyone. Great to be seen. So, kind of on my way up here, as I've done hundreds of times, I actually had a little moment of introspection. I know, it's a big word for me. And I thought about how great our firm has grown over the last 2 decades or so. Some of you have been with us that whole time and have seen that journey. And I think about the strength and talent of our team now, the technology we have available to us, our national footprint, these events that we put on very often. To me, it's amazing. And it all started 40 some odd years ago with one man, a dream, and a phone book. So if everybody could maybe just raise your glass and a quick toast to John here. Cheers, El Jefe. So I guess I've stalled enough, right? So I guess we got to really get to the point of why we're here. And so we're going to attack the material as we normally do, right? We're kind of used to this cadence. We're going to talk about where we've been, which is essentially just putting up the slides we showed you at either the kickoff or the previous halftime, and then seeing how that worked out, right? Almost like a scorecard. Did our process put us in the right spots? Then we'll take stock of where we are now. Let's look at all the things that are happening and kind of distill, as John said, cut through the noise and figure out what data points are really important for us to take into account as we build our new investment thesis. And then most importantly, where we may be going, right? Let's take all those fundamental, technical, and behavioral data points, synthesize them, and then figure out what do we think the market looks like for the next 6 or 12 months, right? So that we can then plan accordingly with our investment strategy. So where have we been? So we talked about this in February, and it was really a year of change in terms of massive tailwinds becoming what we thought were going to be headwinds. And what I mean by that are these two. So we've had fiscal stimulus longer than we possibly needed it, right? They went years and years beyond what was really necessary. And then a Fed that held rates artificially low, again, for too long of a period of time, which was good for the market, right? You don't fight the Fed. It was propping the market up, not only in 2021, but probably the previous 10 years, right? The bulk of that rally was because of an inflation of money supply, right? Period. So if that's positive, then the corollary has to be not necessarily negative, but certainly not a positive, right? So we're going to explore these ideas of what's it mean for the market when we take away the stimulus. And again, they keep fainting on that one, like to try to put another inflation package out. Doesn't make any sense to me. But we're kind of coming off the stimulus, and we're definitely tightening. You know, the Fed's raised rates, not a whole lot, but from 0 to 2.5, 2 3/4, they're starting to move. So we'll figure out what that means, later on this afternoon or this evening. So inflation, we were all over inflation for the last couple of years, right? And so the title is Inflation Rising Faster Than Expected, right? It's the same slide I put up a year ago. And I said, rising faster than who expected, right? We were here the whole time, right? This is what they were telling us. We were telling you, no, that's really inflation, right? Remember the Fed was like, oh, 4, we're done. No, not even close, right? And why did we know that? It's because we've read an economic textbook at one point in our life, right? So all the stuff you hear on the TV, it's all nonsense, right? All these different opinions. There's one thing that creates inflation, and that's the money supply. So if you notice here, yeah, we're going along. Ooh, great financial crisis, right? Doubled the money supply. And then the last 2 years, at this point, it was only up 30%. Now it's up 40, right? So you got a 30% acceleration in the money supply. And too many dollars chasing too few goods is what creates inflation, right? And so I laid out this exact example to explain that over a year ago, right? So here we go. We got $10, 10 apples. It's $1 per apple, right? So we inflate the money supply. Now you have $13. Now here we had COVID, right? Supply chain disruptions, dislocations, whatever you want to call them. We only had 5 apples. So yeah, the price went up. And so what the government was telling us was that, oh, once this is all worked out, we're going to be back to normal. I don't think so, right? Because we still have $13, even though we have 10. Here's your inflation. This is what we're feeling on an ongoing basis in food and energy, right? So we were way ahead of, calling nonsense on what we were being told about inflation. But what we did say to temper the negativity of that was that we have something that's called trend inflation, right? Does anybody have any idea what that regression, what that trend inflation number is? It's for a gift. Guess, any guess? It's higher than 2, that's the Fed's mandate.
7.
It's like 3.8. Who was closest? 4.5. On your honor. Anyone? 7 was the closest to 3.8? Cat, whoever it was, you know who it was? Come on. Actually, maybe 2 was. You're right. 2 was close. All right. So what we said was that for the last 10 years, inflation's been below trend by quite a bit. So it's just mathematical, right? We can then go above trend for a while and then theoretically be on the long-term trend. So we weren't too concerned about inflation because in general, inflation's not that bad for the markets, right? Equities, commodities, homes, those are inflationary assets, right? So we weren't too concerned about it. What we were concerned about is what the Fed was going to do about it, right? And we said this. There's 2 ways they can get this wrong. They can go too slow, which makes inflation where it is now, right? So check, they got that one. And the other way that they can screw up is by then going too fast raising rates and pushing our economy into a recession, right? So that was the only thing that really concerned us. And again, this is a busy slide, but all I want you to see from here, this is irrelevant because this is before the first rate hike. These lines are what happens the first and second year after the Fed starts raising interest rates. The only one we didn't want is this orange one. And that's when they go too fast, right? You notice the market doesn't love that. The rest of them are fine, right? Generally, rising rates are a sign of a healthy economy. But here's our risk. Fed goes too fast, right? The other things that we looked at were stock prices, right? John mentioned this too. 2021 was a huge year in the markets, right? S&P was up 30%, everything was up. And in February, we noted euphoria, right? This is how positive people were about the stock market at the beginning of this year. More positive than they were in '99, back in the days where, pet.com or anything.com went up 1,000,000%, right? It was worse than that, based on things I look at anyway. So that wasn't good. Not only were people buying massive amounts of stock, they were borrowing, this is margin debt, they were borrowing money to buy more stock, right? More money than they actually had, right? And we usually see that kind of activity near market highs. So again, this was early in the year. That's not good. And look what that buying did to prices, right? we've got just a general PE ratio here. It doesn't really matter how you value that particular metric. They're all looked about the same. And what I want you to see is here's about the average. It's about 15. We're at 25, right? Stocks were really expensive at that point. That's not great, right? And what was even worse was, and remember, I just said that 25 PE multiple is expensive. Look at some of these things, right? Remember all the meme stocks that were happening, and Zoom, Peloton, 2,100 PE. That was priced as if everybody in America was going to have like one in each room of their house. Ridiculous, right? Zoom, 2,900. Like we're all going to have subscriptions and never see each other again, right? That's those levels of ridiculousness. And again, that usually tells us that the market's getting a little bit too frothy, right? That's not good. And really, a lot of that is a behavioral phenomenon. We've talked about this before. It's called Dunning-Kruger. You might have heard it saying, just enough information to be dangerous. I like to call it the peak of Mount Stupid. And what that means is that just because stocks are going up and people make money, they all of a sudden think they're geniuses, right? Oh my God, I'm so good at this. I'm going to quit my day job. And that usually happens right at the top, right? So again, we're seeing all these phenomena. This is why we use a lot of behavioral in the process. I see all this happening in the market, and that helps us in our way to the evidence go, we might want to be defensive this year, right? Another thing that we thought was going to be difficult for the markets to handle was the reversion. And what I mean by that is, for the longest time, probably 15 years, the only thing you had to do was buy a large cap growth stock, really, right? You buy the QQQ and buy nothing else. And that's because interest rates were low. When interest rates rise, growth stocks do very, very poorly, right? Value stocks do better. So what we figured was there was going to be this confusion with the markets. Most participants hadn't seen this type of thing happen, so we figured value was going to do much better than growth this year. Now on to our technicals. Again, you guys are used to seeing all these from me every time because they're always relevant. So here we have a cycle composite for the market. Don't really need to know what's under the hood, but there's three things. There's a seasonal cycle. There's a cyclicality to the markets. There's a 4-year presidential cycle and a 10-year decennial cycle, and they're all just mashed together here. And what we're looking for is shape, right? Not number. We're looking for shape. And what was this telling us in February? Market usually goes down the first 2 quarters based on this cycle analysis. So we knew we had some tough sledding ahead, but we were looking out for this, right? We want to be defensive here because here's the liftoff. Okay, that's not bad. The box. There you go, Shelley, Diane. The box. We've been in this box. This is the 3rd meeting we've been in this box. We're hoping to get out, right? So at our last year's halftime, we were just entering the box. And I said, for some reason, between the first year and the second year of the presidential cycle, we get volatility. And it's just the way it is. And we usually get a pretty meaningful pullback, right? But what we're looking for is, again, you don't want to be a hero here. We want to protect the money here because once we get out of this, you'll notice that's the best leg in the entire cycle, and we can quantify that. So the average drawdown, just look at the 2 numbers on the bottom, if you can see them around the podium. The average drawdown is 21% in this time. The average liftoff after that's 47%, right? So again, we were in the box, we've been in the box. We'll talk later about if we've exited the box or not. And then we look at our matrix, right? As a refresher, this is just measuring supply and demand within and amongst asset classes. And what we noticed here is a weakening, right? So you saw how equities moved to the 2nd spot. And if you happen to remember, it's recorded for posterity, but I had mentioned that these 4 boxes were all so weak, even though this one's kind of shaded green as we do for the 3rd box. To me, these were all really uninvestable, right? The gap between 2 and 3 was a huge chasm, right? So yeah, we had commodities moving up because of inflation, equities weakening, right? So that was just kind of building on our hypothesis. So how do we do, right? We'd said this year is going to be tough. Let's stay defensive. Well, S&P through the end of June was down 20%. Wow, that number's familiar, right? Let's look at value versus growth. Value down 12, growth down 28, There's that reversion we were talking about. International, down. Bonds, down, right? That was another thing we talked about. It's going to be a hard environment for bonds with rates going up. So I walk away with this really, really positive, saying that our investment process kind of nailed every problem that we might have this year and put us in the position to be defensive. If you look in your accounts, still, depending on what model you're in or allocation, you're still somewhere between 20 and 40% cash, right? And I've taken some of the hedging off because we're maybe bouncing on the bottom here. But again, we were defensive, right? We were ready for all this. So that should make you feel a little bit better. So let's look at where we are now. All right, I think we've already established this. This year was bad, right? It was a tough pull down in every index, right? Nowhere to hide, rough market. But this is not uncommon. All right, you've seen this slide from me 100 times. We usually get 3-5% corrections every year, maybe one 10%er, and every couple of years we get something bigger. This was a something bigger, right? And it's been a couple years, loosely, since the COVID drawdown. So again, not out of the ordinary. We also had a bond bear market. That's what made it a little more difficult this year, right? Really nowhere to hide. Your 60-40 portfolio was down as much as your all equity, right? Because bonds were down 15 or 20%, right? So, and those are even harder to hedge than the equity. So it was a difficult market, for anybody involved, even if you knew kind of what was going to happen. So here's our inflation friend again. 8.6%, right? And actually, I think the local high was 9.1. But it's only 6 if you don't need food or energy, right? So we got that going for us. So that's not great. Still not great. That's pretty high, right? And the Fed is on doing what they're doing, right? They're raising rates. And so I think the markets have drastically underestimated how hard it is to put the inflation genie back in the bottle, right? Our last reading was 8.5, and just because it wasn't up, the market was cheering. 8.5. That's a massive number, right? So I think the market's getting a little bit ahead of itself. Does anybody know? I mean, the last time we had a serious bout with inflation was 1980. Paul Volcker was in charge of the Fed. Anyone have an idea how high he had to push rates?
18.5%.
20. 20%. Who was close? I got one last gift. Who was close? Cat? So yeah, 20%. I'm not saying we're going to 20%. We're kind of in a new regime here. But we started from 0 and we're all the way at 3.5. And so the rule of thumb is that the Fed funds rate has to get higher than CPI. So now you're 3.5 and you're 8.5. Are they going to meet somewhere in the middle? I don't know, right? But I don't think we're done, right? So I think that's, again, I think the market's a little bit ahead of itself. I'm not crazy about this. It's not just us, right? This is a global phenomenon. Now this slide I showed you a year and a half ago for a different reason. So that orange line, which was at 90%, was the number of central banks globally whose last move was a rate cut. So we had this kind of global accommodative easing, right? Well, now that number's at 20, which means that 80% of all central banks, their last move was a hike, right? So it's not just us feeling the pressure here. That's not great, all right? Which means we're probably going to have some type of global economic slowdown caused by all this, right? Again, not great. But what's it really mean for us? We've got really 3 possible scenarios here. You got your soft landing, which everyone's talking about. Inflation comes down. Wake up a little snoozy. That's not going to happen, right? You got a better chance of seeing a unicorn. This is not happening. It's going to be one of these, right? We really don't want this. Stagflation, where the government, again, gets it wrong both times. They push us hard enough to get a slowdown, but not hard enough to tame inflation, right? That's a terrible scenario. The more likely one is here. They raise rates real fast. They cut inflation down, but it's going to be a little bit of recession, whether it's a deep one or a shallow one. Something in this vein, though, is probably the most likely. We'll explore that right now. So, again, this is another one of those things, a recession. Everybody likes to put labels on things. And the definitions vary. You could ask 100 economists, you're getting 100 different definitions of what recession are. So, I mean, recently we had 2 tiny negative quarters of GDP print. I think if you go in the dictionary, that might be the definition of recession. But the National Bureau of Economic Research, the one who actually calls recessions, has a different metric, and they haven't called it yet. So again, at the end of the day, I don't think this matters, but the 2 red negatives aren't great, right? We'll leave it at that for now, until we get to the end. So what I like to do is look at just 3 or 4 indicators that have much higher predictive ability on calling recession. One of those, well, wouldn't you know, it's called the leading economic indicators. Well, that's convenient for us. What you see here, these peach lines are recessions, and what you notice is this curve kind of rolls over 6 to 9 months before the recessions. Now, last time when we were together, we were still spiking up. But here, I don't know, maybe it looks like we're curling over, possibly, right? So, I give that a frowny face. Housing starts, right? Now, this line is not smooth, the regression like the other ones, a little bit choppier, but clearly you can see this is rolled over. And again, this is one of those where it's not great, but it's about time, right? Remember we talked about the stock market. On a real basis, home prices were and still are more expensive than they were before the crash in 08, right? Think about that for a minute. So again, housing prices way ahead of themselves. Kind of mind-blowing in some areas, to be honest. Yield curve inversion. You have all heard a lot about this, and then is it the 10 minus 2? Is it the 10? There's a million different inversions that could happen. But the reason we measure inversion is because of what it's telling us, what the market's telling us. So the Fed only has influence on the short end, right? The long end is market-driven. So when the Fed raises rates on the short end, the reason the curve could invert is because they're pushing this up, but the market's going, we think you're going to push us into a recession and eventually have to backtrack, so longer rates will be lower. Do you see what I mean? So that's why the inversion is considered negative, and it's happening all across the board at this moment. So again, yeah, not another non-smiley face. The only aberration is jobs. Right? Again, this was another thing that the market was cheering about a couple weeks ago, the blowout jobs number. But 1, it doesn't make sense, and 2, I'm not just questioning, are just people taking second jobs because inflation's so high, right? I mean, we could be double counting here. This number doesn't make any sense. But for now, it is what it is. We'll take it as a check. But ultimately, everything we just went through, I don't think matters, right? So come away with that soundbite. The market is a discounting mechanism. What's happened for the last 7 to 8 months is the market trying to figure out how deep the recession is going to be, right? It's not like we go, oh, we're in a recession, market goes down. It's the other way around. Market goes down first. That's what we're doing now. Now the market's actually, and that's why it's gone up recently, market's going, oh, maybe we're done. They're looking to next year to go, I think the Fed's going to start cutting rates next year because they botched this thing on the front end, right? That's kind of what we're counting on. So again, whether you measure it from the recession start date or end date, look where the market is up 2 and 3 years out. These are big numbers, right? So again, whether we're in a recession or not, it just started, we're halfway in, we're almost out, doesn't matter. The market has already done that adjustment. We've already gone through the pain of what's about to happen from a stock market perspective in the economy. So to me, that's check mark. All right, so let's get to the most difficult part. So we got to figure out what data points are relevant, right? What fundamental data points do we want to look at? What technical ones? What behavioral ones? And again, synthesize those and figure out what we think the shape of the market looks like for the next 6 to 12 months, right? Because rear view mirror does nothing for us, right? We need to know what's going to happen next. And so the one thing you know you'll never get out of me as actual number forecast, right? Because I think I see it on TV all the time. I think this is the biggest exercise in not only futility, but hubris, right? Think of all the millions of things that could happen, the iteration of things that could happen between now and Monday. We have no idea what the stock market's going to do Monday. Think of the ego it takes for somebody to go, yeah, 1 year from now with a billion possible combinations of things that could happen, the S&P is going to be at 4,526. Ridiculous. Anybody who tells you run the other way, right? It's impossible. What we can do, though, is figure out the trend, right? Just like we did the first half of the year. We figured the trend was down. That's usable information. Now we're going to try to figure out, is it still down or is it going back up, right? So this ties back into the other slide. Remember we had that global slowdown? Well, a slowdown, yes, but we have growth, right? There's no negative number, well, other than Russia, who cares? There's no other really negative numbers on the board, right? All the meaningful countries looks pretty good, right? So again, slower, but it's growth, right? So we get a check mark there. Lower global inflation expectations, right? So remember, again, this ties into the other slide where all the other central banks are starting to raise rates too to try to tame inflation. Some are further behind than us, some are a little further ahead. But again, those expectations are coming down now that people have finally gotten off the dime and did something about it. So I think that's a positive. The chance of a Fed policy mistake, right? This thing keeps coming back around. Right? They go too fast, recession. We go too slow, inflation stays persistently high. They've already done this one, right? The Fed's been on the Schwinn for the last couple of years. They way behind, 2 years behind this thing. But now it looks like they're getting in the Ferrari, right? But what I do have to say is there's a little bit of a difference between politicians and the Fed. Politicians, I think, are completely inept when it comes to the markets and economics. They seem to have no idea how things work. The Fed, on the other hand, does, right? They're very smart individuals. The problem they have is that to orchestrate, say, said soft landing, you're asking them to do microscopic surgery on the wings of a butterfly, and the only tool available to them is a bazooka. Right? That's how it is. They have blunt objects. There's no way they can orchestrate these things. Not because they're inept. It's just they don't have the right tools, right? But they have to do something, right? Every time I show you this slide, that number gets bigger, year after year after year, right? And here's the Fed's balance sheet, right? We were, all right, well, that's not great. We were trying to, bend the curve here. We were starting to get some traction from all the, the tapering here. And then what happened? COVID happened, and we doubled the balance sheet, right? I mean, this is mushroom cloud territory, right? Because as rates rise, we're refinancing as a government our own debt at higher and higher rates. The service becomes unbearable, right? So we have to trim this balance sheet. But what do you notice? If inflating the balance sheet is good for the market, is trimming it going to put some pressure? Maybe. But the good news is the markets have come back, right? Now, I wouldn't say we're like real cheap like we've been in these troughs, but look how far we've come from P25 down to like 18, right? So stocks are now much more reasonably priced than they were just 6 months ago. That's great. High yield corporate bonds, I think this is still going to be a difficult area. So with interest rates rising, that's one thing. But when you enter a recession, people start looking at credit quality. And what's happened the last 4 or 5 years is that things like, high yield bonds, which are technically junk bonds, have given equity-like returns because the government was backstopping them. The government's pulling away from that backstopping, right? Which means the spread should open up, meaning the amount people will require as interest to hold them is going to go up, which means the prices will go down. So again, this is an area of the market we're probably still going to avoid because I don't like what I see there. But on a positive note, I think treasuries are going to start acting like that risk-off asset again, right? Because I think the market's looking forward to what we just said. Fed's surely going to push us into some kind of recession, and then they're going to pivot to reduce rates, keep the long end down. I think treasuries work, right? So that's good. That's one more asset class that we have as a building block that could work this year. Sentiment. I love this one, right? Remember we talked about sentiment was up here when the S&P was at highs coming into the year. Now look where it is. It's in the tank. I love when sentiment tank. It's a great contrarian indicator. That's a real good positive for me. Ah, Bitcoin. Hello, my old friend. So the reason I like to talk about Bitcoin is because it is the ultimate measure of sentiment. It's the ultimate risk-on asset because it has no value. It's not a store of value. It's not an inflation hedge. It's not a diversifier. Its correlation with the S&P is like 85%. It's just a really high-risk asset, right? So it's a good measure of what's going to happen with the market. And so remember back here, this is when there was that fervor and it hit, I don't know, 50,000 or something. And it was at this point where Coinbase, that popular wallet that everybody has, went public, right? And you can see usually that kind of stuff happens at market tops. Sentiment is great. Let's launch an IPO. Let's go crazy. And obviously it came down quickly by 50%, went back up, but then this year it's down another 75%, right? But now look what happened here. BITI is an inverse Bitcoin product. It means it goes up when Bitcoin goes down. You know, hello, where were you a year ago when I needed you? This thing's down 75% this year. But since that launch, Bitcoin's up 40%, right? Which again, to me, as a contrary indicator goes, that's interesting to me, right? People are starting to want to get back into the risky assets. And then here's kind of, this one takes the cake. So, and this is just a public service announcement. All of these periodicals, CNBC, it's literally worthless. Like, don't waste your time. I mean, I can't stress this enough. It's I don't know, it's street theater, right? So look at Barron's. This, if you can see that, that was May, I think it was like May 26th. If it holds, the low of the market was June 16th. So after the market had gone down like 20 of the 24%, we get this really helpful article from Barron's going, hey, watch out for the bear market. Where were you in December when I needed you, right? So again, when these things kind of come out, you look at them backwards, right? I think that's signaling some type of market bottom. That's good. And then this slide should make everybody in this room very, very happy, right? Bear markets happen, bull markets follow. And then bull markets can be huge. Look at these numbers, 400%, 400%. Even the hundreds, 220. I mean, and so for us as a collective, we were defensively positioned this year. We have a lot of extra cash to take advantage of this, right? And that's kind of, that's the plan, right? But we got a little work to do. We got to figure out where we are in this box. So again, this is the third time we've been together in the yellow box, right? And I had said from the beginning, you just kind of got to embrace the suck, right? We're gonna get through this. We're gonna be defensive. We're not trying to hit home runs. We're just trying to, protect our portfolios. And we are here somewhere, right? Who knows? We might be out. We had a little rally the last couple weeks in the market. Could that have been this rally, or could that have just been this rally? We don't know. We don't know for sure. But what we do know is typically in the cycle, somewhere around Q3, Q4, which would mean in the next few months, we typically pop out of this consolidation. So hopefully when we get together in February, we'll be talking about something other than the yellow box, right? And so again, let's quantify that. Same slide as before. So you have average of 21% pull down. And again, if that June low holds, 24%. So right in that kind of cone of reasonableness, I would think. And then here you have again, 47% is the average move higher. So here's that slide that we showed in February, but now with the S&P overlaid on it. So blue was our shape. Here's actually what happened. I mean, they're not going to go lockstep. That's not the idea, but they're going directionally the same. And that's what we need to know, right? And so here we go. Is this just slid over 2 inches and we're already here? We still got a little more left? I don't know. Nobody knows. But we are pretty close to the bottom based on kind of everything we've looked at so far, right? So that, to me, that's a good sign. And let's look at what our matrix is telling us, though. So it's been a long time since it's looked like this, right? Some of you have been with us for decades. The last time it would look kind of this bad was 708, right, before the meltdown. You really had cash in the number 2 spot, equities 3rd spot, and up to about 2 weeks ago, it was really close to slipping places where with fixed income, 3 and 4, right? And that, again, that would suggest further downside in the markets. But that rally the last couple weeks has caused some separation here. So equities going this way. And what I would like to say about this is these big blocks, think of them as like the Titanic turning in the harbor. They won't actually flip spots until they're all the way turned, but I can see under the surface in the research we do, and so say U.S. equity might already have turned 90 degrees, to where it's going to be up here. So we're seeing a lot of green shoots, a lot of things in the market that suggest it being higher 6 to 12 months out, 24 months out. So again, I'm liking what I'm seeing for the future, but this lines up with what your portfolios loosely look like now, all right? So we've been defensive, and again, that's a good thing because we are about to take advantage of this, right? So anyone who's been here knows this is my last slide, right? So that's one of 2 reasons to be happy. It's a really good slide, and 2, I'm almost done, right? So this slide makes everybody happy. We spend a lot of time here in the minutia, right? We just went through a lot of stuff, a lot of fundamental data, a lot of technical data, and part of me likes to do it, part of me doesn't. Because we want you to know that we're looking at all this stuff, but I don't want you to be worried about this. That's what we're here for, right? And the more you look at this minutia and try to figure it out, the more it triggers the behavioral stuff. The behavioral stuff is what makes us bad investors, right? So again, we go through it because I want you to know that we know what we're doing, but I really want you to have the long view of what's happening here. That's over 100 years of data. There's really just 5 periods on there. Maybe we're in a 6th here. And what do you notice? We've got 3 red boxes. Those are consolidation zones. 2 big moves higher in the market. Now, the reason I started showing this slide 6 years ago was because of this red box. So we entered around 1999, 2000 for the tech sell-off. And we exited around 2016. Did I mention the average period of time of these was 16 years, right? So we actually exited somewhere around 2016. And at that point, what was everybody saying on TV? Well, oh my God, the S&P just rallied from 666 to 2,000. It tripled. That's it. Get out. Market's done. And we were saying, wait a minute. I don't know about that. Based on this research, we seem to have just broken out of the box, which means we could be in store for a 10 or 15-year run in the market. And that was 6 years ago, and the market's doubled since then, right? But it doesn't mean it's over, right? Again, we're only 6 years into this thing. We could have another 5 or 10 years, right? So if we walk away from tonight with anything, I want you to feel much better about the markets, right? We had a tough year coming in. We were ready for it. We talked about that in August. We talked about that in February. But we had the portfolios positioned for it. We have cash on hand. We are ready to take advantage of what looks like a move back into positiveness in the market, which should bleed into intermediate and long term. So again, hopefully you walk away happy from today's presentation because I see a lot of things I like with the market. I think we just have to be a little bit more patient, but we're there.